Hi Moss 4472 team. In this video, I'm going to take you through chapter 1 of our textbook, where we look at accounting as a form of information. Look at the learning objectives for this chapter. At the end of this chapter, you should be able to explain how accounting affects both the supply for and demand of information. You should be able to compare traditional accounting-based systems with process-based information systems. You should be able to explain management's relationship to information and information systems, as well as describe the relationship between accounting and data analytics. Let's look at why accounting information is important. I'm sure you've heard this many times, but accounting is the language of business because it measures and communicates the financial outcomes of a company's business strategy for three categories of business activities. Operating, so how they're doing on their day-to-day activities. Financing, how they're doing in the eyes of shareholders and bondholders. So here we're looking at a company's ability to get equity, and then investing activities on expanding and growing the business. So here we're looking at the various capital assets and etc. So these are the activities that you find in a cash flow statement. And this is information that not only managers, but investors and tax people want to know about the organization as a whole. And accounting allows us to measure the successes and failures of businesses. So management uses accounting information to make plans and to change them accordingly. So it's an ongoing cycle. So now let's look at the public perceptions of accounting. As you know, there's this perception that accountants are boring, accounting is boring. And part of the reason of that is that people have a very limited frame of accounting and they see it as very data and rules based. And these rules are very black and white. And there's these right and wrong answers. And basically, when people think of accounting, they just think of financial statements, and not just any financial statement, but the financial reporting statements that you provide to external stakeholders. And as we know, accounting is so much more than that. One of the reasons that accounting is more than black and white is because we require knowledge of economic context to fuel accounting judgment. And by economic context, we mean what is the business, what are they involved with, what is the strategy. Accounting is really a mix of rigid black and white rules. So some standards are very black and white. For example, when you're evaluating inventory, you can do it using FIFO or weighted average. You can't really use LIFO, right? So LIFO is not allowed. So that is how it can be rigid. But other things have many shades of gray on how you interpret various transactions. And it's very important to remember that accounting is a useful source of information for decision making, which is why accounting information systems are so important, and we need to properly design these systems because they aid management to make decisions, and they serve public interest because accounting provides a framework for businesses to report how they're doing, and this allows investors to compare various financial statements of different companies and be sure that the method of comparison is similar or the same, especially if they're using the same type of reporting standards. For example, IFRS. If you were comparing a company using ASPE and IFRS, perhaps that wouldn't be the greatest. And accountants demand a strong set of critical thinking skills because there needs to be a lot of judgment, and accountants need those skills to find the correct answer because it's not always obvious and there's always balancing trade-offs and various types of interests and incentives. So now that we've talked about what accounting actually is, here is a nice visual that shows that economic activity drives accounting judgments, some of which are very black and white, but there are a lot of judgments that require those critical thinking skills and professional judgment. Accounting data and judgments provide an input and source of useful information that is then used by decision makers to make decisions about the business, and those decisions once again drive economic activity. So now that we know what accounting is, let's talk about what is an information system. In general, an information system can include all the people and processes involved in the supply of information. However, for the purpose of our course, an information system consists of interrelated components, and these components include physical hardware like monitors and laptops, software that users, so people like us, interact with, databases that are used for storage, networks to send data through, as well as the people who maintain these systems. So now let's talk about the functions of an information system. The functions of an information system include capturing raw and organized data, which is the input. So for example, various business transactions. We all know about transaction processing systems like cash registers at a store, where we go in and a cashier rings up, let's say, our groceries, and then we pay the bill. That is the input to the information system. Then this data needs to be processed and stored, and this is the action of the system. So it's usually stored in some kind of a database, whether it's relational or not is something we'll talk about in later chapters. And then the information system provides us with outputs, which is reported information in a format that is useful to decision makers to make decisions. And please remember that data in and of itself is useless to a business until it is transformed into information. So sheets and sheets of data are useless. We're going to talk about data cleaning in later chapters, but remember what we are looking for as decision makers is information. So here is just a visual representation of what we talked about in the previous slide. We have data coming in, so input. It is then processed in the system, stored in a database, and once it's processed, it becomes information that we can use to drive and make decisions. We've talked about information systems in general. Now let's become more specific and talk about what is an accounting information system. An accounting information system performs the same data collection, transformation, and reporting as all other information systems, but this is done specifically for accounting and financial data. So we're not collecting all data, we're just collecting the data that's required and necessary for accounting. And this information output consists of accounting reports used by investors, tax authorities, creditors, and other stakeholders. And then the AIS involves a subset of all business data, which makes it one part of the firm's overall information system. It captures accounting data created by business events that involve an exchange of economic resources. So remember, when we talk about accounting data, we usually have some kind of economic resources exchange. So for example, if we go back to our grocery store, when we pay for our groceries with cash or credit, that is an economic exchange. We're giving up money in order to get food. And a business event in general is a single business activity in a business process. How complex should accounting information systems be? Well, the answer is it depends. Small businesses use less complex standalone AI systems that focus on the accounting equation and the financial implications of the underlying business events. Many small businesses, for example, use software like QuickBooks. I'm curious if any of you have used QuickBooks in prior jobs, but large companies use more highly complex AIS systems that they usually integrate into the company's enterprise-wide information system. So in this case, the AIS is just a module or a series of modules in the ERP or the enterprise-wide info system. And please remember, as with anything, as companies grow, their information systems also grow in complexity. So a lot of times an AIS system is correlated to the size of an organization. As I mentioned in the last slide, accounting information and data is really a subset of the business data. So here's just a visual representation of that. We have input data from various business events, and then the accounting information system filters that business data. Then it is stored, for example, in a standard format as our general ledger, and then we use that information to create outputs such as financial reports. In order to understand accounting, we also need to understand the business operations. So remember that with for-profit businesses, the main purpose of that business is to, first of all, generate a profit and generate enough cash flows to continue operating. And a lot of businesses fail not because they're not profitable, but because they have poor cash management. So it's very important to make sure that the inflows of cash are equivalent at least to the outflows so that the business doesn't run out of money. The main reason for the profit motive is that stockholders will not invest in a company if they do not expect to earn a competitive return. Remember that there are many forms of investments available for investors, so they need to make sure that they choose an investment that's profitable. So businesses need to be profitable to attract investors, and then profit needs to be reinvested into the business to expand operations and fund activities. So if an organization wants to grow, it needs profits to come in to fund various activities such as expansions, whether geographical expansions or product expansions. Profit is necessary for that. And now we're going to discuss what a business model is. And a business model is basically the organization's plan for operations. It includes identifying who the customers are, which products they're going to produce, any type of operation plans, where are the sources of revenue, and where is the financing coming from. A business model includes strategic plans that consider profitability, investor input, risks, and also social responsibility. There are many types of business models that companies can use. For example, there's franchises that allow individuals to purchase and run a franchise of a known business. And an example is a fast food chain. We all know McDonald's and Tim Hortons are franchises. Canadian Tire also utilizes as type of franchise model. And this model, you have the franchisor and the franchisee. The franchisor provides the franchisee with the brand name and various resources, for example, recipes to make various products, or if they're pre-manufactured, those products. And in exchange, the franchisee is required to pay the franchisor a set fee plus a portion of their profits. We also have subscription services, which involve charging a monthly subscription fee for unlimited access to a service or product. I think we all use some kind of a streaming website, so whether it's Apple TV or Disney Plus or Netflix, these are all examples of subscription type businesses. Then we have freemiums. And these types of businesses provide you free services, but charge a fee to access upgrade features. So Dropbox is an example. It gives you a certain amount of storage, and if you want more storage, you have to upgrade. Same thing with Spotify. You can use the free version, but then you have to listen to the songs that they choose. And if you want to upgrade, then you have to pay your monthly fee. There's also peer-to-peer businesses that connect individuals with one another. Airbnb, Uber are types of peer-to-peer businesses. And then we have direct-to-consumer businesses that sell directly to consumers. So Apple having their own Apple stores. In this type of way, they sell directly to their consumers. Apple also uses retailers like Costco, Best Buy, and all these other stores. So retail businesses are another type. And please remember that large corporations, like my Apple example, can use multiple business models. So in this case, we talked about Apple using the direct-to-customer model, as well as other retailers selling their products. In this course, we're going to spend quite a bit of time talking about business processes, and we're more interested in actual business processes versus transactions. A business process is a group of related business events designed to accomplish strategic objectives, and a basic business model consists of three primary business processes. We have the acquisition and payment processes. So here we are purchasing goods and paying for them. So if I am a manufacturer, I would be purchasing raw materials from vendors and paying for it. If I was a merchandiser, I'd be purchasing various finished products that I would be then selling in my store. So it all depends on the business model, but it is the acquisition of inventory. Conversion processes is where businesses convert the items they acquire into a product to sell. This is mostly for manufacturers. So for example, an acquisition process, if I am a clothing manufacturer, I would acquire fabrics, and then I would hire various seamstresses, and they would change those fabrics to shirts, pants, dresses, etc. So that is the conversion process when the seamstress is actually sewing the clothing. And then we have our marketing, sales, and collection processes. Once we have the finished products, we need to sell them to customers. So if we're a direct-to-customer business, we would be taking the clothing into our stores. For example, let's say I'm Zara, I'm manufacturing the clothes, then I am selling them in my various Zara stores. I'm creating marketing campaigns to attract customers, and then how I collect money from those customers, whether I'm selling for cash, credit, am I accepting Bitcoin, etc. Those kind of things are all part of the marketing, sales, and collection process. Our processes consist of various business events, and these business events actually generate data that is an input into our accounting information system. And accounting filters and records the data appropriately and transforms it into usable information. And every business process comprises of one or more interrelated business events. There are 4 types of business events. So we have operating events that occur during normal operations and are related to the company creating and providing a good or service to its customer. Think back on your cash flow statement of what consists of a operating event. Then we have financing events that help a company operate by acquiring incoming cash flows to fund operating activities. So these are events like issuing more shares, doing a share split. It would also include getting a loan from the bank or issuing bonds. Then we have our investing events that provide a long-term value to the company by purchasing long-term assets that will deliver value in the future. So if we go back to our clothing manufacturer example, if this manufacturer purchased additional sewing machines, that would be considered an investing event because these machines can be used for multiple years to create various clothing items. And then we have information events, which obviously don't show up on our cash flow statement, but they are important because they involve an exchange of information and will never involve an exchange of economic resources. That's why they're not included in the cash flow statement, because there's no economic resources exchange, but information may be exchanged. So for example, going to a vendor and asking them for future prices of different fabrics, you acquire information, but because you're not making a purchase, this isn't an operating event, it's just an information event. And business events combine to create these business processes that we talked about, and the company's information system captures the data of interest about the various business events that occur. Now let's talk about the evolution of various accounting systems. In the past, there was just traditional transaction-based accounting systems that only recorded accounting transactions. So here, every accounting transaction would be recorded in the journal and then posted to the ledger. Now, there's more and more process-based information systems that incorporate accounting systems as a module to a more fully integrated system that looks at the entire business as a whole. They collect and process all data of interest to the business, and they are connected to all the processes. So with these types of process-based systems, our accounting system is just a module versus a separate system. And there's a lot more information in process-based systems than our traditional transaction-based systems. With our acquisition and payment processes, these deal with, as we talked about in a previous slide, with the business buying and paying for resources that the company needs, like inventory, Our conversion processes convert resources to goods and services that customers want. Converting fabric to a dress is our example. And then we have marketing, sales, and collection processes, which involve selling items and goods and services and then collecting cash from these sales. We know that information systems and accounting systems collect information, data that is transformed into information. But how does management use this information? People who use information created by information systems are referred to as management, end users, stakeholders, and decision makers. And management oversees business processes through planning, implementing, monitoring, and changing and improving processes. So management uses information about how the business is doing to look how well they're doing, changing strategy, planning for the future, and implementing those changes. So let's look at these tasks in greater detail. Now we are going to look at planning. Developing a strategic plan to create a sustainable competitive advantage is something that every organization needs to do. And once they have this strategic plan, they need to design business processes focused on achieving strategic goals. So once you have a plan, you need to figure out how do we execute this plan, and this is done by the business processes. And in order to do this, you have to figure out what are your key performance indicators and what kind of benchmarks do you want to reach. And then you need to identify various opportunities for the business in the market, as well as assess various risks and how to deal with these risks. We're going to talk about risks more next week, as chapter 2 is all about risk. And then part of planning is forecasting future performance. For those of you who took management controls with me last semester, you know that we use forecasts and we compare them to actual results, and we try to determine where variances are to once again modify our strategic plan. Once we have a plan, we need to implement it. So implementing or putting into place a strategic plan, and this involves dividing high-level business objectives into smaller processes and events. It also includes assigning employees to perform various activities. So who is part of these processes and what are they doing? You need to motivate employees to maximize their performance. Once again, this is kind of a little nod back to our management control class where we talked about employee incentives. And then you also have to embed internal controls into processes and systems to prevent and detect errors and fraud. We're going to talk about internal controls and fraud in later chapters. So this is kind of it's coming. So now we're going to discuss monitoring. And monitoring is all about evaluating the operating results and financial position. And it includes assessing whether strategic objectives are being attained by analyzing your financial statements, using data to monitor risk in real time, monitoring your key performance indicators, KPIs, and comparing them to benchmarks, auditing processes, systems, controls, and transactions, and comparing actual performance and metrics to forecasts and budget. So here you're trying to assess how the business is doing based on the current strategic plan. Once you know how the business is doing, you can look at changing and improving areas that there might be different deficiencies. So you might change designs of business processes or events that so that actual results meet expectations. If they are below expectations, you can constantly improve the design and correct any issues that are identified. You can prosecute occupational fraudsters to the maximum extent of the law to send a zero tolerance message to management and other employees that fraud is not tolerated in that company. And you can improve internal controls to decrease opportunities for errors and fraud. So you're analyzing any deficiencies and making changes to improve the business. So now we are going to discuss management's responsibility for business processes. The relationship between business processes, information systems, and management is iterative. So it's constantly moving together because of the responsibilities of management relate to business processes. So think about a circle that keeps going round and round and round. Management decisions affect business processes, which then affect the data the information system captures. This affects the information management receives, and then this affects the decision making that may result in changes of business processes. So it just keeps spinning and spinning, and one thing affects the other. So here we just have a visualization what we talked about in the slide. We have business processes capture the data. The data is fed into the business system, our AIS system, for example, and then the information is retrieved and it affects management's planning, implementing, monitoring, and changing and improving. And these decisions will then affect the business processes, and we can see kind of a circle going around and how all these factors influence each other. So remember that one of the themes in our course is data-driven decision making. So management needs to combine principles of the quality of information and the decision context to identify the information needs from an AIS system for decision-making activities. And there is always a cost-benefit analysis being performed to ensure that the cost of obtaining the data are not more than the benefits of actually having the data and transforming that data into information. So it all depends on the decision context or the decision that is being made. If it's a decision that doesn't affect profitability much, you probably wouldn't spend hours or days retrieving data. If it is a decision about the future strategy of a business, you would probably take more time to ensure you had all the correct information. And information quality refers to the suitability of information for a particular purpose in a task. So you're making sure that the information actually provides perspective and is suitable. If I am making, let's say, a decision on, let's say, production, next year's production, information of sales from the current year would be helpful. Information about the sales that occurred 20 years ago would be useless for me. It would not help my decision. So that's what decision-making quality kind of refers to. And then we have data integrity, and this refers to the completeness, accuracy, reliability, and consistency of the data through its life cycle in the information system. So you want to make sure you have data that has integrity, so it's error-free, there's no duplications, there's nothing missing or omitted. And the way that this is created is business events create data. The AIS system then transforms raw data into useful information, and management makes use of the information to evaluate the organization's success and make decisions on that organization's future. Now we are going to talk about the fundamental characteristics of useful information. So what types of characteristics does information need to possess to be considered useful? There's two, and there's subcomponents of each. So we have relevance and faithful representation. When we discuss relevance, we are talking about information that must be capable of influencing a decision. So it's relevant to decision. It can influence that decision. And faithful representation refers to that information being unbiased and accurate. So in order for information to be relevant, it has to have predictive value. So it has to be applicable to future event. It has to somehow have the ability to predict of what may happen. Then we have confirmatory value, and that refers to the ability to either confirm or change previous decisions. So is this decision good or bad? So for example, if I released a new product and I received the sales results and they were very weak and low, it would mean that customers don't want that product. And then we have materiality, which means that it will have a significant impact on decision, and not including that information would have an influence on the decision. So if I didn't receive the sales information for last year, it would change my opinion because I wouldn't have it. Then when we talk about faithful representation, we need to make sure that the information is complete. So it includes everything necessary. If I wanted sales from last year and I only received January sales and I was missing February to December sales, that information would be incomplete because it's not 12 months of data or information that I'm receiving. Information should be neutral. So what this means is that it's not favoring a particular outcome. It's objective, and it has to be error-free and accurate. Now that we have discussed the fundamental characteristics of information, let's talk about some enhancing characteristics of useful information. And the usefulness of information increases in the presence of these four enhancing characteristics, but these characteristics are optional. They're not fundamental, but they do enhance information's usefulness. One of these characteristics is verifiability. So information results in the same conclusion by independent and knowledgeable individuals. We have timeliness, so the information should be recent and available in time to influence relevant decisions. So last month's information is timely. Information from 20 years ago is not timely. Understandability, so information should be easy to understand because it is properly classified and presented clearly. For example, if you receive a visualization or let's say, line graph showing you sales over the year, it's more understandable if you receive rows and rows and rows of data. And then we have comparability. So information presents similar items in the same manner to make it easy to identify similarities and differences when necessary. For example, if we're looking at sales trends, it'd be great to have multiple years of information in a visualization versus, 1 year where you have 2 months and then another year where you have 5 months and another year where you have 6 months. That would not be comparable. I've already alluded to decision context in a previous slide, but now let's look at what decision context is. Decision context is the preferences, constraints, and other factors that affect how a decision is made. The decision context helps to understand the intended use of information. Who are the users and why do they need the information? A constraint on information, as I mentioned before, is always its cost effectiveness. And a cost-benefit analysis needs to be done to see if the information is worth the resources needed to access it. And management needs to combine the principles of quality of information and decision context to identify the information needed from an AIS system for decision-making purposes. Now let's look at the differences between reporting and analytics. Reporting is the process of aggregating data into information on the activities and performance in a company. So you have your financial statements are a great example of reporting. You are just showing the business's results. In contrast, data analytics is the process of using technology to transform raw data or facts into useful information. Reporting usually provides a strictly descriptive view of what happened and does not seek insights into the context or reason. So just reports information as is. In contrast, data analytics answers strategic questions beyond historical reporting by transforming data into insight. It looks at questions: what, why, when, how. Reporting and data analytics are dependent on one another, and both are useless without a robust information systems that captures the business process data. So that's why we spend so much time discussing data integrity, because both reporting and analytics require robust data within the information system. And data analytics can range from small data transformations in software like Excel, so making a graph in Excel, to advanced modeling using AI software and techniques. So here we have a useful visualization that looks at the relationship between data, useful information, and decisions. We have business events are captured in our accounting system, which are stored then in a database. The accounting system is used to create reporting and analytics by transforming the data into useful information. And this reporting and analytics is then used by management to drive their decisions. This will then affect our business events, and it's an iterative process like we discussed in the previous slide. That is it for chapter 1. I hope you found this lecture useful. If you have any questions or comments, feel free to email me, and I'll see you in class and the next video. Take care. Have a great day, everyone. Bye.